And hi, everybody. Welcome to another edition of Your Money Radio. Danny Stewart, Don Vandervoort, live with you. Don is in New Jersey. Danny is here in the great state of Texas with me. And we've got a lot to cover. We've got stocks under $10. That segment's going to continue this week. So we're going to give you the criteria to which we choose stocks under $10. Don's got a stock under $10 for you to research. Research only, my friends. These shows are for what? Your edification purposes only. Never ever be misconstrued as advice. If you want advice, need advice, I'll show you how you can get that in a second. Don, I want to do earnings trades. But Danny, we just bought a stock.
We did.
But before that, Don, what's your shirt? I want to show the people your shirt. There you go. Oh, Don, I cannot hear you. Let's see if Don can fix that while I
That was me. That was me. I muted. The dog was barking. Just the Step Brothers.
So that's all right.
The Step
That's
Brothers
okay.
Prestige
Listen,
Worldwide Mythical Company.
Don is operating from the great state of New Jersey. He is visiting his mother. So we're going to have dogs barking. We're going to have sister interludes. But listen, it's all in the family with this show. So let's just keep rolling. And so Skyworks, Danny, we just bought Skyworks. This is my jam. This is the setup I like. So look, when I'm looking at Skyworks, I'm looking at a stock that reports earnings next Thursday. I've got a 5-8 cross. I got a stock yesterday, holds at 21. And now it looks like it wants to challenge these recent highs and maybe make a small run into earnings. If it wants to take out 138.42, I think it could get very interesting. But if I take this down to a 4-hour chart, you can see I've got a beautiful, look at this gap test, shakes out all the weak shareholders here. And now I've got this pattern where it's just an oscillation. It's just an oscillation. It's just an oscillation. It's just maybe potentially an oscillation. And you have to understand why do I love 3 weeks tight? Why do I love flat-based trading patterns? And it has everything to do with continuation. So when you buy a cup with handle, I don't know, Don, what's your favorite chart pattern?
It's the gap up on monster volume. My second one is a pullback on lower volume to the 21-day exponential moving average.
A lot of people like the cup with handle. I'm not a fan of the cup with handle. I'm just not as big of a fan as the cup with handle. When you get a cup with handle, my friends, so when you get a cup with handle, a stock goes up 15, 20%, it corrects, then it wants to make a move and then shake everybody out one last time, and then it wants to accelerate. The thing is, this handle often, well, I shouldn't say often, it fails. It can fail. But when you get from a cup with handle a flag, not a flagging pattern, but a consolidation into a flat base, whether it's on a daily, a 4-hour chart, or my favorite, 3 weeks tight, those are powerful continuation patterns. So if the story of the stock's still intact and the story of the market's still intact, you typically go on to make your next leg. And if you can find stage 2, stage 3 bases, those are pretty powerful. So hopefully that all makes sense, but will I hold it through earnings? It depends on what my gain is. I laid out my criteria for earnings this week on revereasset.com. So if you go to revereasset.com, and I want you to go to Daily Market Insight. You go to Daily Market Insight, and all you have to do is scroll down through the videos this week. 4 stocks at highs, so that we'll cover that trade a little bit here. Using options to trade between the hedges with pets. That is the video I believe I told you I defined what makes me want to stay, what makes me want to go, and I started talking about it here on July 13th. So the criteria is all out there if you want to research it. And if you want any help with that, have any questions, concerns, comments, take umbrage with anything I'm saying. Nobody takes umbrage with anything that Don does or what Danny does, but all you have to do is reach out right here, Tim at Revere Asset, Don at Revere Asset, and then America's Fiduciary right here, keeping people out of life insurance. Danny, what's the worst kind of life insurance?
Well, an annuity product is the worst, I think. Annuities.
Well, between the 2 forms of life, geez, Danny, give me what I want. Between the first.
Jim, did you know an annuity product is actually life insurance without a death benefit? It's actually an insurance product, but
there we go.
But if you're going to do life insurance for the death benefit, more often than not, cheap term and invest the difference is a better way to go than trying to buy a permanent life insurance with as an investment. And whole life is really tough.
Whole life is really tough. Danny, can you just be honest that whole life is the worst thing Jesus invented?
You'll have a lot more at the end of the day when you expire for the whole of your life if you take the difference of premiums and invest it.
And that's a good way to say that.
You're
I don't
essentially
think Jesus
self-insuring.
invented that. I think it was maybe the other side that invented that.
Oh, Lucifer.
Good one, good one.
Do you think there's a Lucifer that works at Raymond James or Edward Jones? For sure there's a Lucifer at Merrill Lynch, right?
Hey, speaking of which, Tim, I do have an article from your favorite place that we want to talk about a little bit later.
Well, the F in Wells doesn't, the Wells Fargo, the F in Wells isn't for Fargo. People of Fargo should be pissed that there's a Wells in front of their name somewhere. All right, so let's do this. So we covered Skyworks. I'm looking for a run into earnings. We'll see if it takes place and lay out the criteria as that trade unfolds. So that's Skyworks. We're gonna do things that we did this week. But let's do you want to do stocks under $10, Don? Do you mind if we start off with that, and then we'll cover our moves here real quick? So look, stock nerds, market lovers. Let me find. Oh, I've got to find it. Where's the Google Slides? Where are the Google Slides that I need for? Are they here? No, they're not here. Give me a second, fellas. I have lost my train of thought on my Google Slides, so I'm looking. Oh, how did I do this again? Don, can you? Don, I'm going to cover my screen up here for a second. Or Danny, can you just talk for a second while I try to find the slides to which I was working from a second ago?
Well, sure, I can actually talk about that Wells Fargo article I have if you'd like.
That would be awesome.
Okay, so this is Wells Fargo's own words, their own article. So the report came out that Wells Fargo's profit dropped 70% in the wealth management division, 70% year over year. The advisor headcount is down, way down. They've lost over 500 advisors. Now, they claimed that it was due because of higher allowances. So they're kind of sandbagging so they can beat next time. But here's the thing that I think is terrible. They said that while departures increased their Q2, increased in Q2, they said a lot of the people that left were because they were below average producers. So they're blaming it on the people that left. They weren't producing enough. Actually, that's not really what happened. Some of the best guys that actually are money managers that actually want to be proactive and manage the money, they left because they're no longer allowed to do that anymore. At Wells Fargo, they're doing these pie charts. And remember, just a year ago, they got caught changing the way they were doing it and not letting their advisors be real advisors, making them do a pie chart with BlackRock or one of the other providers in the background.
Because I love you. In summation, that's why Wells Fargo sucks.
Yeah.
There you go. Okay, so now
blaming it on people leaving.
Back to stocks under $10. So here we go. I got the charts, Danny. You did a great job. Thank you. You stalled for me. I couldn't find what I was looking for. I found it. I'm like you two. I found what I was. No, I don't think you two still hasn't found what they're looking for. So Don, let me show you this. I'm on FinViz, right? And so I have screens. I have a growth screen here, and everyone, pause the video right now. This, you can use this growth screen that's on FinViz is free, and you can find some really good stocks. I'm looking for a list of 10 stocks or less every week based on my growth criteria, and you can see some of the names that this turned up. Okay, so I've been toying with the now you'll notice none of them are under $10. So over here to the right of your screen is price. None of these stocks are under $10, and $10 is real attractive right now. And I was wondering a couple weeks ago, could I figure out a way to find stocks under $10 based on some of my criteria? So I'm going to give you that screen right now. This is Danny, this show is a value add, man. I'll tell you, we give it all away for free. So I'm going to take my screener here. I'm going to go stocks under $10, and you're going to see my screening criteria change. And I'm going to sort them, and you can see that it's sorting them now by price. And so not all of these stocks, listen, there's a lot of reasons, and we've covered this in the past, that why we don't trade stocks under $10. And it all has to do for me, and I'm going to speak for Don here in a little bit, with the word consistency. They don't trade the way the stocks that we usually buy trade, meaning there's a pattern to them. There's a fundamental similarity to them. And when they're not, and it's more important that when they're not acting right, we know to sell them right away. And that consistency allows us to use the velocity of money to keep our ball moving forward, meaning our equity curve comes from the lower left to the upper right. But that doesn't mean you can't make money in stocks under $10. So I've got a few pieces of criterion, Danny, that I'm looking for, okay? And I don't know if this spells an acronym, but I'm just going to list them here. I should have made a slide for this. But it starts with fundamentals. Like, what are the fundamentals? And I can have a little technicals. So it's F and S, little fundamentals, or F and T. So fundamentals and technicals. Then I'm looking for a pattern. And so I'm going to take the names that are, say, under or around $10, like right in here, and I'm going to look for a type of pattern. And so, well, what kind of pattern would I be looking for? It would really be something like this. And so, like, here's Zanga from last week where we started talking about this. Zanga starts, it's got my moving average set up, it's got a cross going through it. And then if I take it down to a 4-hour chart, there's the pattern, just like I demonstrated with Skyworks, SWKS, and then you get your move higher. And so that's how I found Zanga. And so now I can't tell you that the stocks BioDelivery Sciences, Turkcell, AMRN, SLM, LPG, or MyTech are anything special, because I don't know that. But let's look at, do you want to pick one of those, Don, real quick, and then we'll get to the stock that just, this is random. I don't know what Don's going to pick. Do you want to pick one of those to look at, Don? Oh, you're muted, my friend.
You're muted again, Don.
ZNP.
HZNP? That's not under $10.
Oh, where's the list of $10 ones?
It's the first ones. They're the first ones right here.
Oh, my bad.
That's okay.
Amarin, I remember that name from the past. That's a biotech that has come and gone.
AMRN. So we'll look at AMRN. I don't know what Amarin looks like. This is not a good chart. Let's pick another one. So I would eliminate that. TKC, Turkcell. That's not bad. So Turkcell is, I believe it's literally Turkish, a Turkish cell phone company. 820, it's above the 8, above the 5, above the 21. That's not so bad, but there's a last component that I want to show you that I'm looking for. Is that stock TKC? How is it doing compared to the S&P 500? And so when I'm looking, and it's not really doing that well. And the only way to really find that, you can build it yourself, but the easiest way to do this is to just go to investors.com, find their charting, and then you can see on a daily chart how it's doing relatively against the S&P 500. And I'm looking for stocks that have the ability to beat the indices. If not, if not, Don, why not just buy the indice, right?
Exactly.
Yeah. And so Don, what's your stock?
It started as the week as a $10 stock. It's now over $10. Ericsson, ERIC. And you can combine this with one of my favorite patterns, which is the high volume gap up. They reported earnings. This is about a year ago. I made a 5G list of stocks that were potential big winners. Mm-hmm. You may have noticed that several European countries are following us, guiding them to ban Huawei equipment, 5G equipment, and perhaps Ericsson is benefiting from that. I don't really know for sure. I haven't dug into this earnings report, but very clearly something positive happened with Ericsson when you see it up 12% on 350% above average volume. So go to what I did, following my gap rules. I know it's a low price stock. I don't usually buy them, but I set a stop, an alert at the high and the low of today. Sometimes gap ups, that's as high as it goes. Sometimes that puts in a floor and it goes much higher. The relative strength is at a new high on this. That's a very positive sign. So here's something that started the week as a $10 stock and it's, as of this morning, 12% higher than where it closed yesterday. So.
Yeah, and so there's a number of ways to skin the cat. And so for me, and Don's doing the same thing. He's taking one of his favorite chart patterns. You know, Don, we didn't even talk about this really before we went on the air today. that just works out really well. I asked you what your favorite chart pattern was. You said it's the gap up. I didn't know you were going to talk about Ericsson. I didn't even know it gapped up. That's great. Let me see if I can find one. Let me go back to this list here and look, stock nerds, market lovers. If you want this list, not the list, it's the criteria. You have to be able to find ideas. Let's look at.
You also need to look at the volume. Like you may have mentioned that, but
yeah, no, well, it's right here.
Ericsson trades 9.5 million shares a day. No concerns about volume on a $10 stock that trades 9 million shares a day.
I went with over 300,000, and you'd be surprised. Like I've got stocks. I toyed with this for a long time, so I've got stocks here that are still having some sales, earnings per share, like I've got some of my favorite fundamental criteria in here. So you're not going to get a big list. This isn't a momentum list. This is a list that, can I get something that has some earnings and has the potential to actually move higher. So we'll look at what's LPG.
How about can I suggest an enhancement for this screen?
Go ahead.
Over in the right, the far right hand column, institutional ownership. What are the options under that? Because you want to get institutional ownership behind your stocks, because they're the ones that ultimately push it higher. They're the ones with the big money.
Look at that.
That might eliminate something that's on the low end from a volume and a price standpoint. That's one of the 7 letters in CanSlim that William O'Neill started. So that's definitely something I always take into consideration.
And these stocks are so tough. You can see the little mini charts. So let's look at MITK, MITK. So MITK, that's not bad. Earnings coming up maybe next week on Thursday. I'm curious how that looks on this chart here, MITK. Yeah, you've got an RS line that's starting to move higher. That's not so bad, but you got to be able to find your pattern. And so if you take this down to like let's look at a 2-day, see how that looks. Not as great. Let's go the other way on a 4-hour. That's starting to move. But oftentimes what Don and I find is when people email us about stocks under $10, they're either really super passionate about it and they've done the research to high heaven, and it really doesn't matter because what matters most is price. And so you can sell us on the story, but what matters is what happens in price. And one of the best stocks about that, Don, is this one, Plug. Plug's been around for, Don's smiling. Do you want to tell them about it? You're muted.
Yeah, I have got to admire Plug. My hat is off to it. They've been around for 25 years and have never made a penny in profit. But they continue to be listed. They continue to be talked about. They've always got, they've always been right on the cutting edge for 20 years. One of these days, they'll break through, I guess is the story. But
and everybody who's passionate about Plug is going to tell you about Amazon and they're buying their vehicles and this is the future. It's been the future, as Don said, for 25 years. It's a trading vehicle, folks. And so the 4 criteria I'm looking for are fundamental, and I'm looking for that fundamental with a screen. I'm looking for a pattern, like a 4-hour chart, a daily chart. I need volume. I chose 300,000. You can adjust it to whatever you want. And then I'm looking for something that's beating the indice, because that's going to help you. And Zynga had all those qualities last week. And even though I only took 3% out of it, and I could have gotten it for 7 to 10% more if I just would have held on like 2 more hours. That's you can look at what Zynga is doing from week to week. So I'm not ZNGA. These things just don't. They when they pull back pretty sharply, which leads me to my next topic. How many of you have wet the bed over the pullback in the NASDAQ? Is that a nice way to say it, Danny?
Nice segue, Tim.
Yeah, the people that sometimes interact with me on Twitter, or that I look at their streams on Twitter, there is a lot of people that must have some extraordinarily high size in some NASDAQ stocks, which why wouldn't you? They're the leaders, right? But Don and I consistently tell you to do this long term, to do what we do long term. And And some of you are going to get uppity with me, and I don't want you to get uppity with me. When I say do it long term, I don't mean that you go to work, you get money invested in your 401k, the company's matching, and you're able to paper over your mistakes. When we see it every day of every year of every investor that we meet that is about to retire, they realize they can't paper over their mistakes anymore, that the money they have to invest with, they pretty much have to grow it from that point. It's a really big deal, and I'm not being facetious when I say this. It's really effing scary. And for years, you've been told to buy the dips, you can make all the mistakes you want because you're working, and something switches when you hit 55 and you can see retirement in your horizon, and then everything in your world just scrunches up, right? And somehow your butt cheeks clench, and you just squeak when you walk. You're so tight. And you need visuals, Don. You need visuals, and that's not the way to trade, by the way, squeaking when you walk. But what happens is you're over leveraged. You've got too much size. Maybe you got 50% in Amazon. Amazon's 10% off its highs, and I know some of you are freaking out. How can it be 10% off its highs? It's going to report earnings. It's a COVID sector. Everyone's buying off of Amazon, and it's not even at the 21. But you have to understand what's normal, and we have to get your position sizing under control. Look, Don and I are it's the velocity of money strategy we've been talking to you about forever. We take 5% positions in stocks when we know they're super duper volatile, but we really like them. You know what we do? 2.5%. And none of that is sexy to you, right? Because when you're right and you've got a 2.5% position, you wish you were leveraged to the hilt. But that works in reverse, and you're seeing that this week. For a lot of you, you're seeing that this week. And then if it's an ETF, we typically take 10%. So Don, unmute yourself, my friend, and tell them some of the normal pullbacks that are taking place in the market.
Yeah, I got a list of 7 stocks here that are leaders in this market. And if you held all 7 of these coming into this week, your portfolio was probably down 10 to 15%, because the least volatile was Zoom, dropped 14% in 2 days.
Hold on, let me pull this chart up. Zoom.
This is actually pretty good. It's got an ATR. You have to know the ATR. You have to understand the ATR of your stocks when you own growth stocks. Zoom actually is on the low side of the stocks I'm going to discuss. Its ATR is just a little over 4%. It got as much as 13% above its 21-day exponential moving average. So anytime something is more than 2 ATR above its 21, you know you're kind of primed for a pullback here, as it's very evident on the chart that you're showing here.
Now, 1 second, Mr. Don. Let me just do this for the folks. We get a ton of new viewers to our work every week. So what Don's describing is managing your portfolio in a probabilistic mindset. So what Don is saying here is that from the mean, or the 21 moving average here, when you get 2 to 3 average true ranges, and Don talked in percentage, I'm talking in price down here, the average day, Zoom moves about 11 points during the average trading day. So today is not a big deal, right? It's only down 1.3%. I mean, excuse me, $1.30. But when it gets extended 2 to 3, statistically, Don, you're saying it's due for a pullback, right? And so you have to, as a money manager, and if you're managing your own portfolio, you, my friends, are a money manager, you have to decide, do you want to hold through that? Or could you redeploy that capital, or could you just reduce risk to a size that's manageable through the pullback, and then maybe add on the pullback?
And this stock aside, if you decide that, yeah, I can live through that, can you live through all 8 of your holdings that are very strong momentum growth leaders doing the same thing at the same time?
100%.
That's what we battle with every day in-house here, because our clients do not want to be up 2%, 2%, 2%, down 8%. Nobody wants to log into their account and see that they lost 8% in a day. We just can't manage money according to the traditional O'Neill concentration rules. And why would we? because we know we're going to get shaken out of a situation like that if our position sizing is too large.
And then just pause there for a second, Don, because here's the other thought to dovetail what Don just said. If you think diversification is going to help you, you have zero idea how the game is going right now. Diversification is just a mask. So you think you're reducing risk, but you're actually taking on more risk. You're diversified in a bunch of stuff. Diversification is for people who will not watch their portfolios. But let's be honest, if you're watching this podcast or listening to this podcast, my friend, you are looking at your portfolio every day. We know you are. You can say, well, I don't check it every day. You check it every day. You check it before you go to bed. Some of you are watching the futures at night like I do. You're into it, and it's okay to be into it. It's completely okay to be into it, but you're checking what's going on, and you have to understand that your position size means everything right now. So go on, Don, give me another stock.
The most brutal one was Livongo, LVGO. This got extended, believe it or not, 42% above its 21-day exponential moving average.
Okay.
And it pulled back 21% in 2 days.
And nobody
never even made it to the 21, as you can see there. It has an ATR of about 7%. So sometimes things just get ahead of themselves, and you got to understand what a normal pullback is. And a normal pullback is not 21% in 2 days, but it could be if you're 42% extended from your 21-day exponential moving average.
Right, and so just to go a little bit further with Don's, hey, to dovetail, we didn't talk about this ever, Don. Don sent this at the end of the quarter, and this is what these major ETFs that are used to diversify portfolios did for the quarter. You're not getting the protection. Sorry, Don. You're not getting the protection you want in the diversification. Does that make sense the way I'm saying it? I'm trying to say it, Don.
It also says that if you just invest in the broad averages, you're going to get average returns. And if part of that average return is the modern portfolio theory spiel that small cap growth always outperforms, you're looking at an index that was down 24% first half of the year. If you go with what's actually working in the market, you can see the NASDAQ 100 is up 16.5% as of 6:30. So
now juxtapose that with Don saying we don't want to be concentrated because you're going to get these huge pullbacks, but you want to be in the winner. So how do you manage that? It all comes back to size, and it all comes back to understanding excuse me, as I chose the wrong chart. It all comes back to understanding probabilities. And so when you're up all the way up here, you have to understand that a pullback is about to ensue. And the easiest way to look at this is, say, the NASDAQ futures. The NASDAQ futures go up and hit the third ATR, and where do they pull back to? 2 ATRs below. They didn't even get back to the mean yet. There's the mean. Maybe they do come back to the mean, but third ATR pullback. Third ATR pullback. You don't even get close to the third ATR, and you just got 2 over it in pullback. So when you see an indice that's doing that, or a stock that's doing that, you have to understand that you're just right for a pullback, and it's okay to take some chips off the table. And this probabilistic mindset has kept us on the right side of the good for so long. Okay, what you got, Don?
The QQQ, the NASDAQ 100, that third ATR normally coincides with an approximately 6% above the 21-day exponential moving average. If I see the NASDAQ 100 is 21% above, I'm not putting a bunch of risk on, especially if you combine it with how low the put-call ratio has been lately. You just can't pile in when the odds are not in your favor.
So let's do this. Let me pause you right there, Don, and let me show you the put-call ratio. This is such a big deal here, where you've got the 10-day moving average for the put-call ratio below 0.6. It's lower than when you had this big 1,800 point drop in the Dow, and that big gap, which you're trading now. The S&Ps are trading on the underside of that belly right there. And then if I minimize this, how does that compare to when the market really started to fall out of favor? So let's look at this. So you've got the 10-day put call here in February pointing lower. You've got bearishness ensuing. I mean, everyone's buying calls. So that's why you have such a low put call ratio. And then you get this big drop. You're now lower than you were in February. So to say, and here's the thing, that's an alert. It's not a timing mechanism. It's not going to tell you when the market's going to drop. It's going to tell you to reduce size, be ready to be nimble. I don't want to be leveraged 100%, over 100% in a portfolio when I see all this happening down here. But I'll tell you, when I do want to get long and I want to become aggressive is when I see everybody buying puts, and then I see bottoms starting to shape up. And why do bottoms shape up? Let me just see if I can draw on this chart. Because everybody's on the wrong side of the trade again, and the market's about to reverse. This is a contrary indicator. Danny, can you explain this a little bit more clearly than I just did, please?
Sure. When everybody's buying puts, they're buying insurance, and therefore the bearish sentiment is huge. And so everybody's bearish. It only takes a couple buyers to make the market go up. Now, on the flip side, when everybody's buying calls, they're uber bullish. Everybody that was going to be in has already bought in. There's no cash on the sidelines to make the market go higher. So it just takes a few sellers.
So now think about it though. Some of you are going to go, Tim, you mean to tell me this thing's been this low for this long? I've been watching your videos forever and you talk about it, but the market really hasn't sold off since the beginning of June. It's not a timing mechanism. It's an alert. And if you're trading small, and you can manage this, if you're trading within your means, you can manage this as an individual investor. And that's what we're here to do, is empower you. We'd love it. Listen, we would love it if every one of you became clients that watch our videos. We'd be kings of the world. I'm telling you, it's an amazing group of people that watch our videos. By the way, if you like the strategies which we talk about and you want some help, or you know someone that might want to talk to us, 855-732-5932. We'd love to hear from you. We answer the phones on the weekends. We want you to become clients because we can help. We know we can help. And the little secret is most of our clients like to trade in the markets, interact with the markets, interact with us while they're trading the markets, and that's fine. We're one of the few shops in the free world in China, if not the only one, that actually lets you talk to the portfolio managers, and we give you everything because we want you to be empowered. We want you in our world. We know we can help. But listen, if you have just questions, call us anyway. We don't have any salespeople. We're not slimy, man. And I'm not saying Raymond James is slimy. I'm not saying Morgan Stanley is Lucifer, but I'm saying Morgan Stanley might have someone there named Lucifer. Shame. So Don, what else you got?
One of the benefits of following this approach too, you talked about me and being nimble. When I did the video Tuesday night, I mentioned 15 of the 21 over 21 list that I track either pulled back and touched or undercut and reclaimed their 21-day exponential moving average. And that is a great low risk way to add quality leaders to your portfolio, because if the sell-off continues and it gets harsh, they're low risk entry points. You're going to be out with a very low single digit loss. I mentioned Tuesday's lows were a very good inflection point to track your portfolio against.
Fantastic. Give me some other stocks that have pulled back. I want people to understand this, because I don't think people realize just how, like when you type in LVGO, that's a beautiful looking chart. Even though it's up at the average, it's up at the third HR, but it's consolidating at the highs, and that's a bullish thing, but it pulled back 21%. It doesn't look like it pulled back 21%. It pulled back 21. And if you've got 30% in LVGO, or you had options, that hurts. Meaning you just had calls, not puts. So what else you got, Don?
Cloudflare was another one, ticker NET. Got 18% above its 21-day, pulled back 19% in 3 days. It's got an ATR of about 5%. So you got your I mean, you got 4 ATR and pullback in 3 days. And understand when you're up at that third ATR like that,
yep,
you're at risk.
And wait, hang on. Let's explain that real quick. Average true range is what Don's talking about. So one average true range is 5%. So you've got to be comfortable. If you're going to buy a growth stock like that, you've got to be comfortable with that stock moving around 5%. That's an average. That's one average move. And what he's saying is it moved down 4 average moves in just in a couple days, down every day, approximately 5%.
Yeah, to get every stock has an ATR. It's a dollar number, but to normalize it so you can compare multiple stocks, you just divide it by the stock price.
Yep.
And that gives you a percentage that you can compare across your portfolio, so you can see what truly, and this very often does not line up with beta for whatever reason. Beta is how much of a move in the market impacts the move in that stock, but your move in your stock can be extremely much more extreme based on how wide its ATR is versus the market.
And by the way, so beta is the volatility relative to the like the S&P or the index. It measures vibration. Okay, the average true range does too somewhat, but I still would rather have something that has a little bit of volatility moving up and down, that's sloping left to upper right, than something that's flatline, that's barely increasing at all, but has a very, very low beta.
Right. Okay. What else you got, Don?
Let's wrap it up with what has really been the leading stock in the market, Fastly, FSLY. That took off like a rocket ship. It got 35% above its 21-day exponential moving average, pulled back 28% in 4 days. It's got an ATR of between 7 and 9%. It was 7% at the high, 9% where it is now. This can change a lot when you get the big pullback, but
there's nothing wrong with these stocks, folks. They're just doing what they normally do.
Right.
And
regression to the mean.
Yep. And so are we saying this is where you should buy them? No. We're not saying to do anything. We're trying to help you when your stocks do hit these probabilistic statistical number. I don't know how to say it, Don. When they hit these probabilities, you have to know to maybe take a little bit of action. And so I've been demonstrating this all this year. CHGG. Chegg last week hit my third ATR, and I took profits because I didn't want to sit through the pullback to the mean. And now Chegg's on the move again, and I took profits in DocuSign when it was approaching this third ATR. I didn't get it out of here, but now look at this pullback.
Bring up Zscaler. That was one I was able to buy 7% below where I sold it at after it got overly extended.
Well, I was just about to mention, we may be getting back into both of those stocks, the Chegg and the DocuSign.
Yep, and it's just, and someone would say, well, that's a lot of trading. Look, let's pull up Fastly. And when someone says it's a lot of trading, why not just stay put? What you're doing, let me explain this. What you're doing is imparting your opinion into the market. It's not a lot of trading. It's protecting gains and minimizing losses, and that's how you grow your wealth. Protecting your gains, minimizing losses, how you grow wealth. Because Don, what's a leading stock like a Fastly, a Zoom, a DocuSign, when they finally do want to break? How far do they fall on average?
72% on average from when they top to the bottom on average.
In a bear market, yeah.
No, any market. It doesn't matter
you don't have to top with the market. If for some reason you lost a big contract or a competitor came and started eating your lunch and you start correcting, it can still be a bull market. But leadership comes and goes.
But 1 second. So for you to say this is where you buy Fastly, I don't know that. Is this just a pause on its way to correcting another 40 or 42% to make that 72% average? I don't know.
I did buy it with a plan. You can see Tuesday's low there. That's the inflection point. That's where the market bottomed. 1% below that is my stop. It's battling right at the 21-day exponential moving average right now. And best case, it closes above it. You can see, note it had 2 inside days there. Actually, I think it's working on a 3rd inside day. I don't know if it made a lower low today or not, but that means it's tightening up. The people that panicked and got out on Monday and Tuesday. And the last 3 days, the stock has really calmed down. Whether or not it goes lower, I mean, it really ran up, had a huge run. It may be base time, it may not be. But this is just the second pullback to the 21. And leaders can ride the 21 up for an extremely long period of time.
Danny, I'm sorry, go ahead.
So Tim mentioned trading. Well, that's an awful lot of trading. See, people have been groomed and taught by the Wall Street that trading is risky. The more you trade, the more risk you have, right? Being in the market is having risk. Being in cash or the money market is not having risk. So if you're proactively taking profits or minimizing your losses and managing those trades, that's actually less risky because your overall average cash balance for the year is lower than being all in just in an S&P fund. That's the first thing. The second thing, Tim, you mentioned a little while ago about diversification.
Mm-hmm.
Here's another little illusion about diversification. There's really only 10 or 15 or 20 mega stocks that are skewing all those big indices, the Dow, the S&P, and especially the S&P and the NASDAQ. There's really only 10, 15 stocks that matter. All the rest of them don't move them. So you really think you have diversification by owning an S&P fund or a NASDAQ fund, but you really have diversification in those 8 or 10 stocks. And when it gives up the ghost, they'll all go down.
I'm sorry, Danny. I didn't mean to look off screen while you were talking. I'm trying. Normally I have the whole show in my head, but I had so much I wanted to cover today that I need to look at my notes today.
Well, so one other thing that Don was talking about, and so was Tim, why don't you just hold those? If they're leading stocks, why don't you just hold those? You can do that if you want to, but then that's why position size becomes crucial. Because if you got a 25, 35% position and it goes down 20, 30, 40%, like Tim said, you're going to wet the bed. You think you've got a high risk tolerance until it happens. Yep. And then you can't hang in there. You'll say uncle at the exact wrong moment.
And it's easy to get FOMO in this market because things move so fast. You see, I mean, Tesla was up 200 points on Monday, only to give it all back, and then to trade up another 100 points the next morning to give it all back. And by the way, Tesla's still not a bad looking chart. And it reports earnings next week. And we'll get into that here in a moment. But
and neither is Netflix after its initially, it's poor reaction to its earnings report, but it's hanging right around the 21.
Yeah, it came right down to the mean. That's if you want a low risk entry point in a stock, the mean is absolutely one of those places. The 50 days is one of those places. It's tough. Like a lot of people like to buy breakouts, and buying breakouts is tough because when you start getting up to these third ATRs, they start to pull back, and you think you're wrong, but you're just a little late to the move. You just got to wait for the pullback.
And the gap rules that I talked about with that gap up on Eric also apply to gaps down. Very often a gap down puts in the bottom on that gap down day. So set an alert at the bottom of the gap down day and then make your decision. Normally, if I'm in it, I give it 1 to 2% below that gap down day just to allow for, a lot of people will put their stops right below that. You don't want to get caught with those people whose stops get hit. So you got to give it a little bit of room below that.
And for the folks that go, how does this work time and time again? You have to understand who controls the market: institutional investors, mutual funds, hedge funds, pension funds, and algorithms. And so when you want to say, well, that's a rigged market, I'm just participating in the market to which I see in front of me. And so understanding that when Don says that if the NASDAQ, the QQQs, get 6% above the 21, it's ripe for a pullback. And so what does Don want to do? He doesn't want to go out and necessarily short it. He might, but he also understands, okay, if I buy QQQ stocks, centric stocks, what am I in for right here? Well, are there QQQ stocks that are at the 21 that'll lessen the blow? Do I want to buy stocks that might be going for a breakout? Maybe not, because Don knows the probabilities. Am I saying that right, Don?
Yeah.
Yeah. And so
absolutely.
it's developing that probabilistic mindset doesn't happen overnight. You're going to get burned enough times to realize there's probably a better way to do this than hold and hope. And and believe me, the Fidelities, the Schwabes, the Raymond Jameses, the Merrills, the Morgans, they want to infuse you with old world thinking. And let's be honest, I think indexing, it's not going to go away. There's just too much money tied up in it. But so many people don't want the junk that comes with the index. You don't want the garbage. And let me explain this. And so this is why it's crucial you understand when you're delving into individual stocks or accelerating indexes that you need to have a probabilistic mindset. So here is, let's look at SPX on the daily chart. That's a beautiful bullish chart of the S&P 500. And then if I look at, say, the NDX, the NASDAQ 100, it's a good looking chart right there too. But if I type in RSP, this chart is not as good as the S&P 500. What's the RSP? The RSP is an equal weighted S&P 500, meaning that Microsoft weighs just as much as Apple, weighs just as much as Johnson & Johnson, weighs just as much as Caterpillar. But when I do SPX and I'm weighting Google higher and I'm weighting Apple higher and Microsoft higher, you get a look at, show you, this is the 200 day. This is the 21. That's the 8, the green line, and the purple line is the 5. So take a mental snapshot of the SPX and then look here at an equal weight RSP. There, it's just, the last 3 days, it finally crested the 200. And so
that looks an awful lot like the chart of IWM, the small cap ETF.
Yep. And think about that. Well, you know, Bob, we've got you some small caps, we got you some emerging markets. You really got a worldview portfolio. You know what you got, Bob? You got screwed. And so why? Because you got one of the weakest indices, but because Danny calls them pie charts, but it's salespeople at Raymond James, salespeople at Wells Fargo, salespeople at Morgan Stanley put you in this. And to make matters worse, they put you in their kickback profit sharing 12B1 mutual funds. So you don't know what the expenses are. You could construct this yourself. Danny, what were you saying about the annuity that somebody got put in for like 2% a year? You could have just built it with a bunch of ETFs. It happened to someone we know and love, right?
Yeah. So they, especially in retirement plans, they put annuities inside the retirement plans. The retirement plan itself, the 403B or the 401k, it's already tax deferred. You don't need to have, or an IRA even, you don't need to have an annuity inside something that's already tax deferred. And then they put you in this variable annuity, and then inside the annuity, you own these mutual funds. You can just buy those annuity funds outright, and have the exact same pie chart without paying 1.5% on top of that, just for the privilege of having that annuity wrapper. It's just wrong.
So many people do more research when they buy a car than they do with the financial products that they're being put into. And we don't sell any products. It's just strategy and execution over here. But when you're at the places I'm always mentioning, and you have mutual funds, the person that puts you in those funds, you have to call them and ask them, is there profit sharing between you and the fund? Is there profit sharing between the fund and every time they get placed in the company?
The fee sharing, the terminologies are fee sharing. Which of these funds are you getting fee sharing with your company and the mutual fund family? Please disclose all the fee sharing arrangements.
And because that's costing you money. And if they say, well, it's no cost to you, underperformance is a cost to you.
Well, it's built in the fund.
Yep.
And it's almost as bad as an annuity in a tax advantaged account is owning an active mutual fund in a taxable account, because a lot of people if you bought in right before that big swoon this year, the 35% drop. Not only did you lose your 35%, you're going to get hit with a tax bill for the capital gains that mutual fund took, unwinding the positions that it made profits on during 2019.
Yeah, it's when the fund bought the stock. It's not when you bought the fund. And not only that, toward the end of the year, even if they're not doing so well, they do window dressing. They'll go pick and choose a couple of stocks they've had for a while that have gains to sell those, book them, so that they'll send you a capital gain to make you think in your mind they're doing pretty well. What they did is they sent you a liability.
There's so much to that. And so you're not, in the parlance of diversification, so many of you think you're diversified based on the funds that you have, and you're not. What you need to understand is there's only about 5,500 tradable stocks. Of those, how many of them are really investable? And then you take that smaller number and you realize there's more mutual funds and there's more ETFs than there are investable stocks, institutional grade stocks. And so when you understand that, you have so much overlap in the funds that it actually adds up to more risk.
Yes, if you listen, so let me put that in plain English. What Tim is saying is, if you've got a pie chart of 6 or 7 different mutual funds that are American equity, whether they're small cap, mid cap, and you look at the holdings within each fund, you may own Microsoft 4 different times. You may own Apple 5 different times.
Right.
And then you're paying the carrying cost of the fund. Hell, just go buy Apple yourself. Go buy Microsoft yourself. And here's the biggest thing. Forget about the expensive fees. They, by their prospectus, they got to be 95 or 90% fully invested at all times. You think that the fund represents you, they have to follow the prospectus of the fund. So they can't move to cash and get defensive, even if they think the market's dangerous. They get an influx of cash, which normally happens after a run up because you get performance chasers. They get a whole bunch of cash. They got to start buying stocks at lofty prices at 3 ATRs, even if the fund manager knows he shouldn't be doing it. But in a market sell-off, he can't move to 40, 50% cash. He's got to be fully invested. So it's your job to know when to sell the fund, not the fund manager. So if you're doing it yourself, you got to know when to have the mutual fund. If you're going to like Ray J or any of those others that Tim mentioned, you need to ask them, what's your sell discipline? How will you know when to sell this fund? Your answer is going to be, oh, we just hold, we just buy and hold. It's based on your risk allocation. It's nothing to do with your risk. It's how much risk is in the market itself. How risky is the market? The market doesn't care about you.
What I want to do next, Don.
But can I add one more thing? Can I add one more thing real quick? To Don mentioned something a little while ago with the stops, and I didn't want to gloss. He kind of went through that pretty quick. So for the new listeners, Don said, he was putting a stop about a little bit over 2% or 1%, where his buy point was, and he said, put it, figure out where you want the stop, and then put it a little bit below that so you don't get triggered. What he's saying is where everybody else puts the stops. Now, here's the thing. You got these algos that are hitting prices a little bit below the stop to the stock price to hit. People psychologically, it's behavioral finance, they will use even number levels. So they'll put it either at $2 below the stock price. If it's at 50, they'll put it at 48. Don't put it at 48. You want to put it at 47.93. You don't even want to put it in nickel increments. You want to use an odd number within nickel increments. And Don said, don't put it at, if you're using percentage, don't put it at 2%. Put it at 2.07% below, because all the 2%ers will get hit first. And if that's enough, it'll bounce right back up. The old adage on Wall Street for market makers is, well, in a bad market, there's always the stops.
And that goes back to algorithms, that the algorithms, the saying in the S&Ps especially, is they leave no stop unturned. And so, and the reason why is because they know where the liquidity, they're going to keep selling until the liquidity dries up. And they've read all the same textbooks you've read. Think about it. They've read the algorithms are programmed to what's popular. Like when someone says, hey, the chance the stock will bounce off the 50-day. A lot of that's algorithmic centric. Why do the 1272 extensions, the 1618 extensions work so well? Algorithmic driven. And so you can complain about it, or you can learn to operate within it. And it's easier to just learn to operate within it because you're just screaming into the wind and no one can hear you when you complain. Don, I want to talk about this week's in a second. I want to talk about this week's 21 over 21 list because you have that video. I want to do some options work with folks. I want to get into options and earnings, and then I want to set people up for next week. But Don, I know you're excited. Look at what I got. You know what this is? It's a mystery box. Well, this is a mystery envelope. Mystery envelope. And for those of you that don't know, I love sports cards. So I re-engaged sports cards when the pandemic hit. I learned how to broadcast so I could broadcast the videos and do a whole bunch of things stock-wise. But I wanted to do it in something that was relatable to more people. Sports cards. I love sports cards. Don, not just one mystery box. 2.
The excitement is palpable at the Razor residence.
Oh,
and
it's palpable at the D Vandenborg residences too.
Is it? Dan, I hope you followed up last week on the disposal, the status of the disposal plan for all of the cards that Tim's accumulating. Do we have any news on that?
I'm telling you, wallpaper.
So listen,
you have to wallpaper his entire neighborhood at this point.
Yeah.
So
that's a lot of paste.
Let me see if I can find it. Where did I put this stuff at? So look, I unwrap these on Twitter, but I want you to follow all of our Twitters because there's a number of reasons why I want you to follow Twitter with all of us. So here is my handle, here's Danny's handle, and here's Don's handle. And so when you follow us on Twitter, we follow you back, and it's the easiest way to text message. It's to message us directly. We've stopped. Danny will give you out his phone number to the cows come home. God bless Danny for doing so. I have stopped giving out my phone number because the text messages are a lot. I don't mind messaging with you on Twitter. Anyone can message me. They pile up in there. I can go in there. It's brevity. Text messages seem to be long. I'll give you my email address, Tim@RivieraAsset, Don@RivieraAsset, Dan@RivieraAsset. But the messages get long. Like it takes time to answer those because you're asking very thoughtful questions, and I don't disrespect you by giving thoughtless answers. So it takes me a little bit of time to get back to you because I'm spending a lot of time in my email. Twitter is brevity, man. They limit you, well, not in the direct messages, but most people are brief on Twitter. I want you to follow me. But listen, Danny knows that the family that waxes at night together stays together, and you'll get, I don't even know when the last time I did a wax at night was. Oh, Don, that was a mystery. Don, did I tell you about that mystery box? Where'd Don go?
He's right there.
Oh, I lost him on my screen.
You did not tell me.
$300 rookie card I pulled out of that mystery box. Well, it's selling for $300 on eBay, meaning people have paid that much for that particular card. Card prices have skyrocketed. But I'm going to open up one of these mystery boxes on Sunday on Twitter. So,
but would you rather have that $300 card or a Davey Day Trader Global baseball?
I take both. I love what Portnoy's doing. He's given the big this to all the blue check marks, all the people that tell you that you can't do it. He's 100% right. Like, he's empowering individual investors. Some of you are going to say, well, he's taking them down a road to ruin. Dave Portnoy has no responsibility to how you trade. He has no responsibility to your lack of or thoughtfulness towards risk management. He doesn't. He's providing you content that hopefully you find value in. That's all he's doing. And people getting. He's
also made the point. Do you know how many pandemics these experts, these Wall Street experts, have traded through? 0. You know how many pandemics I've traded through? 0 until this one. It's a level playing field.
Yep. And so I love it. I absolutely love what he's doing. He's trying to get people empowered about investing. And if you don't agree with it, that's too bad, because I think you're missing out on the bigger picture here, which is something we've been hammering home forever, that Danny tells you it's pay to play on TV, man. It's pay to play. It's not expertise. Smart people, man, don't make great trades. That's why there's no economists that trade stocks. Smart people don't make good investors. They don't. They don't. They teach in college settings. That's not a knock on colleges. It's just name me the economist who can tell you everything that's going on with the economy, but they can't make a dime in stocks. And so there's something to be said for that. Danny's story.
Harry Dent had to shutter 3 funds, opened them, and so 2 years later had to shutter 3 funds.
And even worse than an economist is one with a political bias, like Paul Krugman.
Yeah, there you go. And so here's Danny's Twitter. One Danny's story, you'll get interesting stuff like this, roller coaster type GIFs, and then Don Vanderboord. Well, you'll not only get market information, but you will get to see this guy. I don't understand the allure of what these people are doing. Like, what is like, why? I don't understand. I genuinely don't understand what the attraction is here.
Because as Forrest Gump's mama said, stupid is as stupid does.
Yeah, but I guess like to find.
It just ruined a nice truck. It was a nice truck until he got bought.
You know, like people are that hungry for attention that they're willing to do that.
Man, that's quarantine for 3 months. You can't get out and do anything. They're just got.
When I open up these, I'm entertaining myself. And if other people are entertained, I'm happy about that. Like I couldn't do mystery box, by the way, on Sunday. I've got, it's called I think it's going to be here by Sunday. I've got 2 of these, and then it's called like the 3-2-1 mystery box explosion. Don, 3-2-1 mystery box, boom, explosion.
Blast off. I see the cleverness in that. Yeah.
That's what the title of the mystery box I ordered off of eBay is. I don't know how fabulous this is going to be, but with a title like 3-2-1 mystery box explosion, and you got to do the hand signals, it's got to be good, right? Like it's got to be the best mystery box Jesus has ever invented.
It's got to be better than driving a pickup truck into a telephone pole when you're not behind the wheel.
That's what I'm saying. It's 3-2-1 mystery box explosion. I pray that it gets here today or tomorrow so I can open it up on Sunday. It's going to go boom. Like what? You don't, and this seller, by the way, has like 100% user rating on eBay. People would, if you label something, so look at that. See, Don, I knew it. When you label
100%.
something, 100%. When you label something 3-2-1 mystery box explosion, and you've got 100%, that's like having a stock at or near new highs, but it's sitting at the 21 and its RS rating is at an all-time high, right?
That's a pretty fair comparison, yeah, very clearly.
So Sunday night, 3-2-1 mystery box explosion. God, I hope it gets here because I am so excited.
You're one of us.
What's that, Don?
Yeah, like Danny said, that makes one of us.
Oh my gosh, that's what Danny said? I just usually tune him out in these earphones.
That makes one of us.
One of us. Look, sports cards have exploded. If anyone wants to talk sports cards with me, hit me up on Twitter. So let's do this. Don, I want to talk about a little bit over the 21 with 21 video, and I want to show people where they can find that. So little trick here, stock nerds. Fridays. If you're watching this, you already know. On a Friday, we post the video podcast early. Normally, it gets sent out 8 a.m. Saturdays, and it gets posted to the Google Play and Apple Store on Saturdays, and it gets uploaded. But you can find Don's videos on Friday where he covers 21 stocks over 21 in the Daily Market Insight tab, and that's how you get a jump start on your market research side. Tell me, give me a little preview of the 21 over 21 this week and things that you're going to be covering without giving it all away, because we got to tease them, right? They got to go watch the video.
Yeah, well, I'm going to review. One of the great things about a leaders list like that is it gives you instant feedback on what's actually going on with the market. And as I mentioned in Tuesday's video, I pointed out that 15 of the 21 pulled back and touched or undercut and reclaimed their 21-day exponential moving average. And there's going to be a couple in there that are flirting with the 21 by the end of the week. And that gives you the feedback as to the strength and weakness of what's going on with the list. Is it, does the weakness in some of them tie to a particular sector? Is it just stock specific? Is there something that changed with that particular stock? Lots of things to consider within the leaders list, but there certainly has been some rotation. Solar stocks have been good this week. You nailed the breakout in housing stocks. Gold stocks are going sideways and really we're really putting in some relative strength. So maybe time for money to come out of some of these high flying momentum stocks. But for now, from a goal line standpoint, they're holding the 21. But again, Tuesday's lows on a bunch of these are critical.
Yep. So I'll tell you what, that's a great, so listen, if you want that video where Don gives you, it pretty much serves as a watch list for the upcoming week. It's a real powerful list. I'm sorry, I keep moving the screens on you guys. revereasset.com, daily market insight, and you'll see Don's, what do you call that video normally? I forget what the actual title
The big
is.
show.
The big show. Let me find the big show. Well, there's a big, it'll call it, just look for the words big show, and that's the 21 over 21 list. Really powerful list. You know what? Let's do that. You just mentioned housing. Let's talk about a trade I've been kind of tracking for a while. We'll start with bonds, and I covered this a little bit last night in the normal video. ZB, we were talking 30-year treasuries. Were we talking about housing today on the call, or did we talk about it earlier in the show? I actually forget. We were talking about mortgage rates on the morning call, weren't we?
The morning call for the
yeah. So look, this ZB chart is super duper bullish. This is a bullish chart of bonds, 30-year treasuries. And so for those of you that aren't as familiar, when you see a price of a bond go higher, the yield is going lower. Not everybody knows that, so don't assume. And so we have a position in TLT where TLT is really developing a really nice pattern here on a daily chart. And so I've been in TLT for what seems like ever, and it just vacillates. I'm in at 164.90. Not the best entry I could have had, but you can see TLT isn't really a big mover per se. But I've translated this into tracking the ZN. And so the ZN is the 10-year Treasury note. And then you can translate that into the TNX, which is the yield off of the note. And so all this means is that I want to show you the direction of yield, lower. Okay, this is beginning of June. This is the end. Now we're heading towards the end of July. The economy, in theory, is getting stronger. We should be coming out of this COVID malaise, and yields though keep getting weaker, and it's a really big deal. But that is translated into bullish trades in MTH, which is Meritage Home. And Meritage is another high today, and it broke out of this resistance area that it hit last week. And it's going to report earnings on next week. I believe that's Thursday. And then translate that bond work into CR. Gosh darn it, Danny, I do it DHI. I do it all the time. I was about to put in Darden Restaurants again. How to stop myself. Darden's having Darden. Every time I trade
those are not the same chart. Those are not.
I know. I've almost bought the Olive Garden before thinking I was buying DR Horton. And so you can see this is a little tiny gap here today. DHI keeps working. And then derivatives off of that. Here is Restoration Hardware, hit a high yesterday. It's a really bullish chart. And I'm not really sure when RH hits, but I also took it down a step with Walmart. And Walmart this is a really nice looking daily chart of Walmart. And TGT isn't that bad too. I like Walmart a little bit better. People will tell you when the housing's working, you want to buy the Home Depot. You can, but I think you want to trade up in here because I think this is where people are going right here. And you can also do XHB, which making a really nice move, and ITB making a nice move as well. So, but all that comes from the bond work, and those trades will probably start to reverse if you see yields find their bottom and move higher, and you just got to try to be in lock-sync with all that. That makes sense.
Can you put ITB on an ATR chart?
Absolutely. Absolutely. There you go. So there is the what? The third ATR. Third ATR, you get a little bit of pullback. Third ATR, bigger pullback. So is it about to hit third ATR pullback? Are you about to hit a pullback? I don't know. We shall see. But they've run. This is a big move. Look at this nice flat area. This is a big move for the construction ETF, ITB. ITB is more based on housing and construction, whereas XHB has some Home Depot and some Lowe's in it. So does that make sense, Danny, everything I said there?
Yeah. Is that a weekly or is that a daily?
That's a daily.
Okay.
Yep, that's a daily.
That's
So
nice.
yeah,
Full
so we'll see what
disclosure,
happens.
full disclosure, we own both of those housing ETFs and the Meritage and the other.
Oh yeah, we own all of those. Other than Home Depot, Target, and whatever else, we own all.
We own Walmart, we own Meritage Homes, and we own
DR Horton and restaurant hardware. Yep. All right, let's see. Talked about. This is the sheet I'm trying to navigate through. I should really write more clearly so I can read it more. Let's do some options, Don, and then let's get them set up for next week. I'll tell you what, we'll do some options here in a second. Danny, do please the normal show ending. And then what I'm going to do is some options talk for a few minutes, and then I'm going to have Don get them ready for next week a little bit, and then we'll end the show.
All right, folks, listen, if you like what you heard, please tell a friend, tell a neighbor. You can just go to send them to revereasset.com. They can sign up. It just says subscribe. They'll get this podcast directly in their inbox, and our daily market insight nightly short market video. We won't spam you. We won't reach out too many ways. It's up to them to reach out to us. You can also call us, Tim loves this, at Old School at 855 Real Wealth. You can email any of us with questions, comments, or for a complimentary portfolio evaluation at 855 Real Wealth.
And that portfolio evaluation, that's not a sales check. Some of you don't know how to find what stocks are in those mutual funds, and that's okay. Some of you don't understand the 12B1 fee discussion. If you just want us to look under the hood to see if you got hosed in any way, more than happy to do that for you. And again, if we do that complimentary, you're not going to get on anyone's email list if you call us. We're not going to call you. Just get the answers you need. There's very few sources like ours in the world that'll actually just treat you the way you want to be treated. And then if you want to be left alone, leave you alone. And so take advantage of it, please. Don, did you talk about gold? Okay,
I briefly mentioned it, but GDX looks great. GLD continues to go up. Silver's been strong this week. I own PAAS, and I've got like a 25% gain in it. That's been better than I anticipated.
It's been a real nice trade, Don. Don has rocked the Pan American Silver Corporation there. Let's do some options talk. So I did, and this all centers around earnings, and we'll get into it in a second. So a couple days ago, I bought Pets. Let's see what Pets is doing. Pets is down 3% today. So I bought Pets. It reports earnings on Monday. I thought it reported earnings on Tuesday. I bought it when it was moving off the 21 for a small run into earnings, and it made that big, nice move yesterday. It's a high this morning, and now it's pulled back to the 5. Look, when you have options in stock, and I've been covering this in the videos, it's such a binary event. It's easier to hold the stock through an earnings event if you have the rules that we follow or I follow. It makes it very easy for me to hold equity, but holding options, long options, or if you have puts, it's very difficult because earnings are a binary event, and the way options are priced, they're priced so widely. And let me give you an example of this. Let's pull up. Oh, here's Pets. So Pets reports next on Monday, and you can see the implied volatility is about 75%. When I put in Tesla, that reports next week. So when I put in, as soon as it comes up here, TSLA, the implied volatility is already at 140%. That'll probably grow to 200% before the earnings event takes place. And what that means is you're paying extraordinarily high prices for your calls and for your puts. And well, what do you mean, Tim? So if I take this options chain as it populates, the expected move is $250 plus or minus on a $1,500 stock, okay? So it's $1,750 to the upside potentially. That also works to the downside too, but if I go to, I'm just going to keep scrolling, Danny. I'm going to keep scrolling. I'm going to go to the 2,900, not the 2,750s that I just mentioned. Almost $3,000. They're selling them, Danny, for just about $200. You can buy a $2,900 call for $200 in Tesla. That's $400 away, and the move is $250. So you're saying there's a chance. So what you need to, so what movie is that from? Does anybody know? Is that a Jim Carrey line? I feel like that's a Jim Carrey.
Man, that's Dumb and Dumber. Come on.
No wonder I didn't recognize it.
So you've got to understand that the market makers know that the further out they go and the cheaper they price these options, they're attractive to you because everybody dreams of getting rich. Look, that's not to say that Tesla can't go up $500 next week. It's Tesla. I'm convinced that Tesla can do anything, okay? So we're going to have this talk next Friday, and what did Tesla do? We're going to have what did Tesla do through earnings. But just note, I want you to just follow along with it and see how these options change in price as Tesla either goes down in price or up in price, and as it gets closer to the actual event.
Yeah, so basically what Tim is saying in layman's terms is you got to be right more than the expected move. So if you're buying a call with a strike at 2,900, the stock's at 1,500 now, and you're paying for a couple $100 on that stock's really got to move by hundreds of dollars before you even start to be in the money, before you even start getting anything back.
It's really difficult. And so as we noted with Netflix, the implied volatility peaked at, it peaked at about 150%, and now it's down to 36%. And so it's like the air getting let out of a balloon. And so even though there's nothing wrong with Netflix, it just pulled back to the 21. But if you bought bullish calls in Netflix thinking that it's going higher, COVID, you're hosed. And these ranges, so let's take a stock that's about to report earnings again. We'll take Pets, because Pets reports Monday. Look, Pets is tough because it doesn't, let's do Amazon. So Amazon is, populate Amazon. Amazon has earnings going to report this week, the last week of July. And I know that because the implied volatility is highest in this series. As I look down, this is today's implied volatility. That's next week's. $300 expected move in Amazon. The market makers price these out so they have the least amount of risk. The house always wins. So what do you want to do? You want to sell put spreads. You can sell call credit spreads. You want to be the house. You want to sell your options. Buying options right before an event is really difficult. And so if you go back to Pets, what did I do? Pets is pulling back 3% today, but I bought it off the 21. Didn't have to work this way, but let's see what, I've lost some money on these options. I'm going to sell these by the end of the day. Yeah, so my options have come down. You can see they've come down. I own out of the money. I purposely bought out of the monies. They're holding value. Why are they holding value? Even though it's the expected move, these are only monthlies. The expected move is only $7 into August because of the binary event that is earning. So you can buy Delta 20, Delta 30 calls in a series that reports earnings. And even though it's down 3%, I'm not losing my shirt. I mean, I had a gain of 600 yesterday, but now, and I've given back about 400 of that, maybe 500. but you're not going to lose your shirt. And but once the event's known, and I still have these calls, this would be like 58 cents. They'd be cut tremendously. You're going to lose a lot of money. And a lot of people don't, no one tells you this, because everybody wants to sell you on the ability to get rich. Like when you watch other people's stock market videos, they're always winning. They're the most handsome people in the room. Nobody loses. Everybody gets their dreams. There's a reason why Raymond James and Edward Jones, that they never talk about how it feels when your portfolio is down 30%. They never discuss it on a commercial. Like we make fun of people. People ask, we don't make fun of people. We make fun of brochures. People ask us for, hey, send me your brochure. A brochure is nothing but like the best things we could ever put on a piece of paper. Like no one's going to put the truth about their firm on a brochure, meaning, hey, you take losses, or not everybody reaches their financial goals. You have to understand the reality of what you're doing, and no one tells you this. People that want to sell you options programs or get you into trading rooms, or even at the big brokers that want you to trade options, they need fees, man. This whole thing is fees. And if anything we can do is give you reality. So we talk about our losses first. Hey, you know what I did, Don? Let me show you. Don, I took a loss in Ring this week. That was seems like a world ago. Danny, remember when we sold Ring?
Yep.
We sold Ring on the 13th, 710. Is that Ring? Gosh, I don't think that was Ring. That was up here. We sold it not for here. I only sold it for a 2% loss. What the hell happened to Ring? Geez, that's ugly. Gosh, I took a 2% loss in Ring. Wasn't acting right. You can tell I haven't looked at Ring. But before all this nonsense happened, I got to go back. Let me look at my notes. I sold Ring, Danny, for a minus.
It started breaking. It started getting a little bit choppy and breaking down.
2.29% loss because something was not right with this, and I just sold it. And I'm telling you that you have to be able to have the courage of your convictions to take your losses. It's not the Don. What do you want me to say? Making money is easy.
Keep it small. Yeah, keep your losses small is a secret.
Yeah, and so many people will bankrupt their accounts. With the options that I'm talking about.
They want to wait till it comes back. They want to wait till it comes back to break even to sell it. That's just so you don't have to admit internally that you were wrong.
Yeah, and I always tell people, look, if you want to trade options, that's great. We're always here to answer your questions. But before you start trading options, how good are you at consistently trading equities, meaning with your plan? Because if you're not good, trading is difficult because you're fighting all the psychological issues that are out there, as well as the screening process and the rules process. But it's akin to driving your car. If you're not good driving forward, what makes you, which is what equity trading is, what makes you think that if you threw it in reverse and tried to go down the highway that way, you'd be any better? That's what options trading is. It's infinitely more difficult.
So I've got an analogy for you, Tim. I'm just curious. Is that same true with a helicopter? So if you can't fly a fixed wing, a plane well, you're not going to be good in a helicopter?
I don't know. I got to tell you what, man. I flew frogs, CH-46 Echoes in the Marine Corps for about 10 years. And the hardest thing I've ever learned to do was hover a helicopter. No, there are some people that have a natural skill. I wasn't one of those people. And so it took an instructor. You just start drifting and you're out of control, man. It doesn't feel right. And the harder you try, the worse it gets. But when I would drift into the tree line, which sounds weird, but I drift close to the tree line where my visual cues would see the trees, I'd see the ground, I would feel the controls because you're moving both the pedals, power, and all four of your control surfaces are moving at the same time. I got a visual perception. So he would take me over to the trees. He'd go lift the helicopter up. I could hover. We'd go back to the runway and I couldn't hover. So I learned to hover by getting close to the tree line in the forest of Pensacola, Florida, and of the pine tree forest. And then I could figure it out. But it took 8 hours. Like I was so like hour 6, they call him your on wing. My on wing comes to me and goes, Captain Browning, I think it was his name. And he says, "You're going to have to get this pretty soon, or we're going to have a talk," which means we're not going to let you progress. No pressure for the next flight, right? And so, yeah, absolutely, it's really difficult. And so,
So they are hard to fixed wing. Okay, that was my.
Oh my gosh, extremely difficult. Options trading is a breeze compared to flying the helicopter. So anyway, Don, what's going on next week?
You do not want to see the leading stocks act like that ring chart that you just showed. That's a clear breakdown. That was one of the stocks that was a leader, very nice relative strength. Just flat broke down. 3 straight days, hasn't bounced, holding near the lows of Tuesday. If you see more of that out of the leading stocks, we're having a serious rotation going on at best, where the market's going lower at worst.
Agree. Okay, any other parting words of wisdom here as I check off my sheet to make sure I covered everything I thought we'd cover?
Those Tuesday's lows are critical.
Danny, any last rounds or saved alibis?
No, just folks, if you need any help, please feel free to reach out to us. Again, we're not gonna badger you or hassle you. We'd be happy to look over your stuff and tell you where we think you're strong and where you're weak.
Oh, bonus. We had a fella reach out to us and say, "Can you discuss upgrades, downgrades?" I don't want to be flippant. I certainly don't want to do that, but upgrades are a game where the day Tesla went up to, Tesla got like an upgrade, I believe, to 2,300 the day that it came up here to 1794, which was Monday. And upgrades are oftentimes an opportunity. I'm not going to tell you this, but upgrades oftentimes are an opportunity for the people at the trading firms to get out of stocks. Now, Tesla might not be the exact example of this, but if you see a stock that's been beaten down for a while and it doesn't look good, and all of a sudden it gets an upgrade and you're like, what the hell happened here? Why did it get an upgrade? Oftentimes the upgrade creates excitement, buyers come in, and we call it the institutional high five, where the institutional sellers will come in. They'll sell it to you, the individual investor, and then you're left holding the bag in a really crappy stock.
It's similar to pump and dump. It's kind of the same thing. And conversely, on the on the other side, when they miss it, when institutional investors of big money wants to get in, they'll have their guys issue a downgrade so that it pulls back 5 or 10% so that they can get back in. It's just like the earnings, these earnings analysts, these earnings estimates. Do you know that, and I don't know if the stats are just recently, but as of a couple of years ago, like 79, 81% of the earnings missed to the downside so that the company could beat estimates. Now, if you're a good analyst and you're trying to get down to the penny what their earnings should be, sometimes you should be a little bit under, sometimes you should be a little bit over, but it should be around that 50-50 mark. Just by the fact that it's 80% under just shows you that it's a rigged game.
And look, you could paying attention to upgrades and downgrades. If you own options or equity in a stock that gets upgraded and has a big move, yeah, you're the beneficiary of that. By buying stocks just because they got upgraded, you want to use the criteria to which whatever your rule base is, or if you're saying, well, I follow what you guys do at the shop. Okay, great. Well, then we're looking for stocks that are, maybe moving average stack. They're close to the mean. They've got a fundamental bent to them that we like. We buy typically the top 10% of the stock market, fundamentally and technically. We combine those things. And so you need to follow your process, and whatever happens with an upgrade or a downgrade, it just happens. And sometimes, downgrades happen, just like sometimes I've been bitten by this, and Don has too, where they issue more stock and it tamps down down. When was the last time that happened to you? I can't think of a stock that it's done it to me in.
I blocked them out of my memory.
Yeah, like it hurts. Like you're in a leader.
It's been a little while, but look, upgrades, downgrades, you can't predict them. You don't know when they're going to come out. They just come over the wire. But the whole point is, as soon as they come over, it'll get baked into the charts, and you'll figure out how to interpret that based on what the chart says.
So if your stock gets a downgrade, and it pulls back to say the 21, well, you know our stance on the 21. Bullish stocks and pullbacks to the 21 are typically lower risk entry points. So you just gotta know where you are in time and space in terms of your stock and the overall market, and then whatever happens that's out of your control, you can't worry about it. You just have to be able to react within your rule set, if that makes sense. All right, Danny, take us home.
All right, folks. Thanks for listening today. Again, tell your friend, tell your neighbor, revereasset.com. Have a good weekend, and we'll talk to you next week on Your Money.